Hello everybody, again I'm Michael Redden and we're going to talk about another pretty hot topic in estate planning that you guys are pretty interested in. And that is the Irrevocable Life Insurance Trust. Another buzzword you'll hear your financial advisors and other people talk about, they'll call it an ILIT, Irrevocable Life Insurance Trust. These are important because most planning that goes around the death tax or the estate tax or any of those kinds of transfer taxes is going to involve some kind of life insurance planning and a trust like this. But before we get into that, I want to kind of help you out with all these acronyms. Don't worry if you don't recognize these. Some of you will. Most of these will get their own video at some point. If you hear about an IGIT, an ILIT, a CUPERT, a SRT, a BIDIT, a QDOT, any of those things, the T at the end, adapt. The T at the end means trust. And all that stuff in front of it is really a feature. You don't necessarily need 8 trusts, one for each purpose. You gotta have a reason to have other trusts. Any trust that can hold life insurance that's irrevocable is an ILIT. Even if it's your ADAPT, your asset protection trust, intending to keep creditors out of everything. If it's that and it can own life insurance, it's also an ILIT. If this trust can last forever, no matter what features on it, it's also a dynasty trust. So don't get confused by those things. A trust is a trust, but any of those big buzzwords, that stuff is just a feature. So the reason the ILITs are great is because when we're looking at estate taxes and things, we don't want to put the life insurance in your name, because if we go buy a $2 million life insurance policy and you own it at the time you die, we just gave $2 million more for the government to tax, and we really intended for that just to pay the tax out. So we increased your tax bill. So what we'll do a lot of times with an ILIT is we'll make it at the time you're going to buy the policy. The trust will buy it. That way you never owned it. It's never in your estate. You're still going to put money into the trust, whether it's a gift or otherwise. We can talk about gifts and things to the trust later, but you're going to provide the money and the trustee is going to pay the premiums. And because of how we did that, that $2 million doesn't add to your tax bill. It can pay the tax bill, because our estate strategies are either going to be get it out of your estate or plan for a different way to pay the tax. Leverage it so the risk is on the insurance company as long as we can keep the life insurance going. So that's one of those things that we're kind of looking at, and that's what you should think about with these. Now, a lot of times the life insurance trusts, they can serve a dual purpose. Your spouse could have access when you're gone if they need it too, so it can be kind of like that deal. But then when it goes down to the children and everything like that after the wife passes, that's where the real fun begins. It can still be a protected trust by having a spendthrift clause. It can provide for all those kinds of things that you were thinking about. And another really big important reason why we have these things is estate liquidity. If your estate doesn't have money to pay taxes and fees or pay off even the debts on your house, then you got to sell the house. And that's probably not what you intended. You intended for them to live in that home, not sell the home, pay off so they can pay off the mortgage and keep it, because your heirs may not be credit worthy enough to get a mortgage at the end. But the bank is not going to sit there with you being dead and there being a mortgage on there and just take payments from the beneficiaries. They're going to come, and instead of taking payments from your kids, they're going to foreclose on the house. Those kinds of reasons are why you need estate liquidity. And life insurance and an ILIT just provides that way, that's non-taxed money to get that kind of funds and pay those things off. So keep that stuff in mind, and a lot more people should be thinking about an ILIT than do now, because Minnesota's estate tax is very low, and if you need estate liquidity, you should probably think about it.